Greetings, members, one and all of the Salivation Nation. 2020 is going to be a volatile year for precious metals. At least according here to this author from Seeking Alpha, Andrew Haidt. Let's see, and let's find out if we think that gold and silver will end up being higher next year than this. Yes, again, Seeking Alpha, this article here, further correction in silver would be a scaled-down buying opportunity because the author here believes that probably we will see higher precious metals, but we're going to see some volatility along the way next year. And I think it's kind of neat. He goes back and talks about some of the fundamentals of silver and what has happened. So let's explore some of this language, and we can either reminisce and give an idea as to how this plays with today's markets and what tomorrow will bring next year. When digital photography changed the fundamental equation for silver, many analysts believed that the price of the precious metal would never recover. However, demand for silver in computers, cell phones, solar panels, and many other industrial applications arose to more than compensate for the loss from photography. Silver spent most of its time below $6 per ounce between 1989 and 2003. For a lot of that period, the price was below $5 and even ventured below the $4 level. I remember those times, actually, and that was about the time when I could get silver for $4 or $5 an ounce, because silver did reach a low of $3.51 per ounce in 1991. And I remember at the time buying, and by the way, I was not some massive stacker back then. I basically bought bars and rounds and coins because I thought they were cool, and in some ways, when it did get that low, I felt kind of guilty. Why am I accumulating all this? Will it, go lower, or what's going to happen here? I didn't quite fully understand in some ways what I was buying, or, the prospects of it. But I figured, it is silver. It's not going to be zero, and I knew that it will never go to zero. But when it did get down that low, it made me kind of wonder and question. I think in some ways we're in that boat again to some level. At the turn of this century, the price was between $4 and $5. So not much movement upwards in about 10 years there. However, all the concerns over industrial demand quickly disappeared from 2006 through 2011, when silver rallied to a high of $49.82 per ounce, just 54 cents below the all-time 1980 high. Of course, when you adjust that for inflation, the 1980 high was well over $150 an ounce. Each year, investment demand and herd behavior determined the path of least resistance of the price of the precious metal. Meanwhile, silver corrected back down to $13.64 in late 2015. The price of silver has not traded below that level since 2009, or under $10 per ounce since 2008. And that's important to note, because we've reached higher lows than we have before. And that is probably the largest example of silver being a wealth preserver. Really that's the end, is that when you take into account the entire spectrum, the price, silver really does preserve your wealth, or at least it's keeping up, and doing what it does. When you dollar cost average out and look at all the numbers, by and large, there are exceptions, and there are certainly times when it doesn't perform to the level of inflation, but by and large, it does. The last time silver was below $6 was way back in 2004. After reaching a high of just over $19.50 in early September, the price was back below $17 by the end of last week. There are lots of reasons why we could see increased price variance in the gold and silver markets in 2020. The most direct route for risk position in silver is via the futures and futures options on the COMEX division of the CME, or in the physical market for bars and coins. Now, as most of you know, I don't dabble in the in the futures or the ETFs or paper contracts or paper silver. I deal mostly in the physical market. If I'm going to be a hardcore stacker, I'm going to be stacking up some Eagles. For those looking for leverage tools that turbocharge the percentage price action in the silver market, on the up and down side, the Velocity shares 3x long silver ETN. There's a bearish counterpart will provide an alternative. I think Andrew Hyde is known for dabbling in those markets. We're going to kind of skip through that because I think we're going to take a look at the fundamentals of silver, which essentially these fundamentals and this analysis applies to both the electronic markets and the physical markets here. And silver and gold, that kind of ran out of an upside steam in early September. So gold had reached a high of $1,566.20 on the September 4th on the active month December futures contract, and that price of the yellow metal corrected to its recent low of $1,446.20 on November the 12th. So that was a 7.66% decline, while silver reached $19.75 in the December futures contract, and the more volatile precious metal fell to $16.62 on November the 12th, which was a drop of more than double that at 15.87% on the downside on a percentage basis. So that just goes to show you how much more volatile silver is than gold. So even though we may see volatility in the gold market in the next coming years, we're going to see a lot more of it in the silver market, which is going to be discouraging for some of us. The daily chart of December silver futures shows that the market has made lower highs and lower lows since the September 4th peak. At just under $17 per ounce on November the 29th, silver is a lot closer to the low than the high since early September. However, the $17 per ounce level has become a pivot point for the silver futures market since early November, and that's what I thought. I had to kind of perceive the same thing, not necessarily from a technical analysis standpoint, but just from observation. 17 seemed to be a pretty strong resistance point, and silver had held pretty strong there with only a few times, and not for very long, dipping below that $17 an ounce level. And I'm talking about ask price. There was somewhat of a little spread there where the bid price was below that. Price momentum and relative strength indicators are both below neutral headings. So the daily historical volatility has dropped to 10.2% from over 24.5% on November the 13th, as the market has been in a trading range around $17. The total number of open, long, and short positions moved from 229,450 contracts on November the 4th to 206,469 contracts on November the 27th. So, yeah, there's a look and see how that is playing out. The recent decline in the open market, open interest metric could be because of the roll from December to March. Futures in the COMEX futures market, the gold futures market has experienced a decline in open interest over recent sessions as gold futures roll from December to February contracts. I mean, this time of year, typically there's not as much activity. They're sort of stagnant, the markets are, too, even to where they may be, historically, they tend to be lower. And as is to be expected, silver did not accomplish what its yellow cousin did, and that's another reason why I think it's wise for silver stackers to diversify into a little bit more gold. So the gold market broke out into the upside in June when the price rose above the level of critical technical resistance in the July 2016 value of $1,377.50. Gold blew through that level like a hot knife goes through butter and reached $1,560 level. Meanwhile, silver rose to a high of $19.75 on the December futures contract and $19.54 on the continuous futures contract at the same period. The July 2019 post-Brexit high on the silver market continues to stand as a level of long-term technical resistance to the upside. Yes, indeed, and that's been quite some time. The number to beat for that is going to be $21 here, so talk about that, how gold rose above the technical level of the July high. Silver did not challenge the July high, which stands at $21.09. So lower highs and lower lows could lead to a deeper correction. And this kind of gets into some of the technical analysis here, especially as we go into the end of the year and into the beginning of the year. But really, when it all goes down to where this is going is a volatile year on the horizon for 2020. All the factors that caused the breakout of the upside in the gold market and rally in silver remain intact going into 2020. U.S. and global interest rates have declined and are not heading higher anytime soon. While the markets are hopeful that the U.S. and China will reach a Phase 1 agreement on trade, it does not seem like a deal is on the horizon in 2019. Moreover, many issues continue to divide the negotiators. Iran continues to be a thorn in the side of the U.S. and Saudi Arabia as U.S. sanctions choke the Iranian economy. At the same time, there's no end in sight when it comes to the proxy wars between the Saudis and the Iranians. Another deadline for Brexit has come and gone. The next movable line in the sand for the divorce between the UK and the European Union is now at the end of January 2020, and the presidential election next year in the U.S. will be a highly contentious affair. The incumbent president is likely to limp into the contest after Congress impeaches him, and the Senate acquits President Trump. The uncertainty of future U.S. policy and Democrats embracing a progressive agenda that could cause periods of fear and uncertainty in markets across all asset classes. The bottom line is that 2020 could be a very volatile year in markets across all asset classes. Price variance creates an environment where gold and silver prices could continue to attract investment capital, pushing prices higher. The author is bullish for the prospects of gold and silver prices in the coming year, but we could see lots of two-way price volatility before the metals rally to higher highs than we witnessed in early September. And I do think that's why we may see silver touch or at least flirt with $20 per ounce next year, considering all this. And there's going to be a lot of growing pains as we go through these things. And I believe we get some great news with trade. If we get a deal there, Brexit gets taken care of. If those two issues get taken care of, at least for Phase 1 for trade and an agreement for Brexit, well, we could see both metals really take a pretty substantial decline in prices. People feel emboldened in other economic situations, especially if job numbers continue to do well. If job numbers start to drop off, or we see more clear signs of a recession, more than just that bond yield curve, which turned out to really not be much of anything, at least to date. Usually the bond yield curve inversions do happen as a sign, a foretaste of what is to come, and maybe it still is. We just haven't seen it yet. You know, the time between those bond yield curve inversions and when a recession starts, we have to take a look and see historically what that time span is. I believe we are due for another recession. I believe we will see another recession no matter what happens or if Trump gets reelected or not. But how a president handles things and how Congress handles things, the government handles, will be quite telling. Will there be another round, a massive public round of quantitative easing or what have you? Will there be negative interest rates? We'll find out next year. It'll be very interesting to see how this all plays out. But I think that things are going to kind of pretty much soften, or not much movement in the metal prices for the rest of this month. But next year will be volatile. Post your thoughts below. Very interesting indeed. Let me know what you think in this volatility for 2020, what the highs will be and what the lows will be for silver and gold. I think the highs of silver could be around $20 to $21 an ounce for next year, and the lows could be as low as $15.50 an ounce, I believe. I think that's the range we'll be looking at potentially in the coming year. For gold, I think we could see gold go up to $1,600 an ounce next year for its high, and I think we could see it go down to the high 13s, like $13.75 for its low. That kind of volatility we could see. But I don't take my predictions too seriously. I'm just making them based off of kind of what I've seen in the markets as a layman's standpoint there. Post your thoughts below. I'd like to send a multitude of gratitude you all for watching and encourage you to please rate, share, comment, and subscribe.